Hello, and welcome to another tax update brought to you by Tax Essentials for Advisors. I'm your host Andy Rainford. There hasn't really been much to report on over the last few weeks with the government busily reshuffling, but I'll do my best to keep you interested with the few bits I have found interesting. This week we're looking at a new consultation on the reduction to the ISA savings limit, a new tool for voluntary NI payments from HMRC, and a case involving the question of whether travel met the definition of ordinary commuting for tax purposes. The government has published draft regulations and a consultation for one of the most significant changes to the ISA regime in recent years. As announced at Budget 2025, the annual cash ISA subscription limit for people under the age of 65 will reduce to £12,000 from April 2027, while investors aged 65 and over will continue to benefit from the full £20,000 allowance. The consultation focuses on the detailed rules needed to make that policy work. In particular, it contains a series of anti-circumvention measures designed to prevent savers from effectively using stocks and shares ISAs as substitute cash accounts. These include restrictions on transfers into cash ISAs for younger investors, new rules defining what counts as a cash-like investment, and a charge on interest earned on cash held within stocks and shares and innovative finance ISAs. For advisors and ISA providers, the consultation is important because it reveals the practical operation of the new regime. While the objective is to encourage greater investment in productive assets, the detailed rules are likely to require significant systems changes and careful communication with investors before they take effect in April 2027. In other news, HMRC has introduced a new online service that makes it much easier for individuals to pay voluntary Class 3 national insurance contributions. Previously, topping up a national insurance record could involve lengthy telephone calls and manual processes. The new digital service allows taxpayers to check their national insurance record online, identify any gaps and pay for eligible years electronically. For many people, paying voluntary Class 3 contributions can be an effective way of increasing their state pension, particularly where they have incomplete contribution records due to career breaks, working overseas, or periods of low earnings. However, it's important to remember that buying additional national insurance years doesn't always increase a person's pension entitlement. The benefit depends on their individual contribution history, so taxpayers should always check whether a payment will improve their state pension before making it. For advisors, the new service should make pension planning discussions much easier, providing a quicker route for clients who can genuinely benefit from filling gaps in their national insurance record. This case considered whether an employee could claim tax relief for travelling from her home in Colchester to various construction sites across London. The taxpayer worked as a community liaison manager and argued that because she worked at different sites, each location was a temporary workplace and her travel from home should qualify for relief. The tribunal disagreed. It held that her employment was defined by reference to the London area as a whole. Although the individual construction sites changed over time, London itself was her permanent workplace for the purposes of the employment income rules. That meant travel from home to London was ordinary commuting and therefore not deductible. The tribunal did, however, accept that travel between sites within London qualified for relief, and HMRC had already allowed revised mileage claims to reflect this. The case also highlights the importance of maintaining proper mileage records. The taxpayer had kept no contemporaneous logs, making it impossible to substantiate the substantial claims made over a number of years. The tribunal therefore upheld HMRC's discovery assessments and closure notice. For advisors, the decision is a useful illustration of the area-based workplace rules in action and reinforces the importance of good record keeping for employment expense claims. That's all for this short update. Hopefully there will be more to report in a few weeks' time, especially as we have a new Chancellor. Bye for now.
Thanks, Andy, and don't forget our next webinar is coming round fast. Join Andy, Rachel and Jack Bonehill on the 26th of August to look at tax-free benefits for employees. We'll have registration details soon. See you next time.